joining this morning. As Amy had shared with you guys, a lot of what we are seeing out in the market for, the typical types of financing that our clients get typically are going to fall under one of those normal traditional loan products. And we kind of define those as a conventional loan, which is a loan backed by Fannie Mae or Freddie Mac. We talk about FHA loans, which are loans that are backed by HUD or the Department of Housing and Urban Development. VA loans, which are backed by the VA, obviously, and then USDA loans, which are backed by the United States Department of Agriculture. So all of these four loans kind of are your traditional financing options that the vast majority of your clients are going to be kind of engaging with. And so I would say that the data kind of bears out that about 65% of clients who buy a home buy it with a conventional loan. You've got about 15% that are using a FHA loan. You've got about 8 to 10% in that VA range, and then somewhere between 2 and 3% fall under USDA. So the vast majority of the financing types that your clients are going to be engaged with is going to be those products. Now, they are the bread and butter of what we do on the financing side. And I don't want to bore you with just kind of the normal guidelines, right? With just what those programs are. I wanted to just kind of talk about some niche products within those programs that I think could be valuable for you when you are talking to clients. And one of the things that I always, share with agents that I work with is that, I don't think you need to know how the program works from A to Z. That's what you have me for. But what you do need to know is that if you have a client that tells you, hey, I want to buy this house that's a fixer-upper, or hey, I want to sell contingent, and you know that them selling their current home contingent is going to be a non-starter because they're buying in the Bay Area, right? Things like that. You need to know that there are some products out there that might fit and solve kind of what their unique situation is, and then you can refer them over either to me or most of our local lending partners here locally can do a lot of these programs. So I'll really briefly just kind of walk through just the normal quick guidelines for some of these programs. So your typical conventional loan is going to have a minimum credit score requirement of 620. It's going to have a minimum down payment requirement of 3%. Now, what I always tell people is while the minimum credit score is 620, with all of these loans, we basically have to work really hard to get what's known as an automated underwriting system approval, or AUS. You may have heard of the system that we use called Desktop Underwriter, or DU. That is basically a complex algorithm that Fannie Mae uses for us to plug in their credit report, their income, their assets, and push it through with the loan scenario we're trying to get, and then it spits back an approval. What I will tell you is that while the minimum posted score of 620 is there, that generally speaking, if you got a 620 score, 9 times out of 10, I'm not giving you a conventional loan. And I'm saying that for a couple of reasons. Number one, most people who have a 620 score do not have money to put down, so they typically are going to be in that 3% range. When you have that minimum down payment in conjunction with the fact that you've got a below average credit score, the automated underwriting system probably isn't going to like that very much, and it's going to be hard to get an approval. The other piece that comes with it is the way that conventional loans work is they price off of risk. So this is not super uncommon with all loans, but it's especially true with conventional loans. So if you've got someone with a 760 credit score, they're going to get the best rates on the market, top, 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 period, end of story. Those rates start getting worse as we drop credit scores by every 20 points. So as we go to 740, the rate gets a little worse, 720 gets a little worse, 700 gets a little worse, 680 gets a little worse. And by the time you get all the way down to 620, the rate is super ugly. And so more often than not, the clients will see the interest rate that we're offering and they'll go, oh, I can't either A, afford that, or B, those interest rates are not feasible for us. And so what a lot of times we do in those situations is we're going to flip them to an FHA loan. For someone who's putting in the minimum down, whether it be 3 to 5% on a conventional loan, An FHA loan has a minimum down payment requirement of 3.5%. The way that that kind of dynamic pricing as far as the rates that we offer works with conventional, right now, anything under 720, FHA is probably going to price better. So you're going to have a lower rate, you're going to have a lower payment with FHA if you've got a credit score below 720 in most cases. Now, if you're putting a large down payment down, those kinds of things, that could change. But I think in general, that's the case. Now, that's not to say they couldn't qualify for a conventional loan. And in a lot of cases, if we have a client that's looking for a condo, for example, FHA loans have to the condo has to be approved by FHA. In a lot of cases, the condo complex is not approved. And in which case we have to go back to conventional. And even though the rate's worse, the payment's worse, it's the only way to get that deal done. So I don't want to say that conventional is not possible under 720 because it is, but we have to be judicious about how we are applying that for our clients to make sure that they're getting the best terms available to them, the lowest payment available to them, without compromising your ability to get an offer accepted. Right? I know that conventional loans are certainly going to be preferred by the vast majority of listing agents, even though FHA, in my mind, does not. The appraisers are not that bad. They look at some dry rot stuff, health and safety. The old adage is that on an FHA appraisal, the appraiser looks up and down. On a conventional appraisal, they look left and right. Right. So the FHA appraisers are a little bit more concerned with the eaves. They stick their head up in the crawl space. They put their head under the foundation to see what's going on. Like they have some focus there, but I certainly understand the desire to present a conventional offer when we can. I would just say work with your lender partners just to find out, hey, what's the reason that we went FHA as opposed to conventional here? They might tell you like, hey, I couldn't get an approval on conventional, FHA is it. They might tell you that we just did it because they needed a lower payment, and that was where that client was focused on. But in those situations, we can at least have that discussion about kind of what the right path is based on your strategy, what you're seeing out in the market, and what's really needed from you. So that's FHA. VA, zero down. In my mind, it is the absolute best loan on the market, period, end of story. They're allowed to put zero down, no mortgage insurance. The underwriters are super aggressive with qualifying. It is a dream loan for us on the loan side.
I'm sorry.
That
You
said,
said,
I recommend.
I think I missed the beginning of that. You said it's an FHA loan?
Well, we were talking about a VA loan is the
Oh,
best
VA,
in
VA.
my
Okay, yeah,
yeah.
yeah.
Yeah. So
Say
the
what? No down, zero
yeah.
down payment.
Well, we'll talk about that. There are some FHA options with zero down, so we'll talk about that as we go here. But VA, I think, really is where, to me, if I'm a VA, if I'm a veteran and I can get a VA loan, I'm going to push really hard for that because that no mortgage insurance, we're talking at our price points, hundreds and hundreds of dollars a month. The interest rate is typically a 0.5% better than what a conventional rate would be for that same buyer. I recognize though that you guys have a hard time getting VA offers accepted. I wish that wasn't the case, and um, I think there's a lot of misconceptions about VA that are just kind of, especially with your older school agents who've been around for 10, 15 years, like VA loans were harder. There were VA situations where the seller had to pay a certain percentage of fees on the veteran's behalf. That is not the case anymore. The one downside, and whether it's a downside or not, we'll talk about, but the one downside to the VA loans is I don't get to use my in-house appraisal panel, right? So when I helped to create Neo locally, I went and found my favorite appraisers, right? The ones that are stress-free, they're not nickel and diming us on little conditions. Like I got to create that panel and I use that panel for all my other loan types. With VA, the appraisers actually are work through the VA, so I don't get to choose them. And a lot of them are like super old school. And while most appraisers will come in and say, okay, this buyer wants to buy this home for 600,000, yeah, it might be worth 595, but yeah, close enough. I'll find a way to get it to 600. And they they're happy with that because the market has dictated that the house is worth 600. If this person wants to buy it for 600, great. Some of the VA appraisers don't operate that way. They will come back and say it's wrong to charge this veteran 600,000 when the house is only worth 595, and they like stand on that when in fact what they're doing is causing the veteran problems. But the cool thing about what they do is there is something called the Tidewater Act. So if the VA appraisal is going to come in short, rather than me surprise you with it when I get surprised with it when I get the report in, the VA appraiser has to call both agents and say, "Hey, you said this house is worth 600,000. I'm not seeing it. I'm seeing it's worth 595. Can you give me some comps to get me there? Tell me how you got to 600." And they have to actually work with you to try and do that. And so I think that part is cool because it gives the agents a chance to go, "Hey, did you get this comp?" Or this comp that you're using is dated or was an estate sale or something, those kinds of things. And so I think that part of the VA side is cool. But again, to me, it is the greatest loan on the planet. And I wish I could just like if I could change one thing about our industry, it's how sellers view VA offers because it's a bummer when that doesn't happen. Any questions on any of those three? Cool. The last one I'll touch on, and I'm not going to spend a lot of time on it, just the general kind of way that the program works is USDA. It also allows for zero down. It's got mortgage insurance, but it's a reduced figure as far as that mortgage insurance is concerned. The real caveat with USDA is it's designed to be a rural property, right? So these loans were put out there for folks who maybe we're struggling to find property in rural areas. And so there's a map that you would plug the address in to kind of determine whether or not the property is eligible for USDA. And then from there, we would work to see if the client is eligible for USDA. Um, I find that USDA is probably the hardest of the four loans on my side because the automated underwriting system that they use is super finicky. So I may pre-approve somebody like for FHA conventional VA, I know what to expect. I can pretty much tell you by looking at it if I change something on that approval, whether or not that approval is going to stick. USDA, it's completely schizophrenic and it can be a little bit difficult. But again, it's cool for rural properties. They're a little bit more forgiving on some of the rural nature of the property itself than you might find with some of those other options. So I'll put the link to the map in the chat if you want to just bookmark it and save it. If you want to use that at any point just to see if a property that you may have your eye on might fit within that kind of geographic structure. Okay, so from here, what I'd like to do, I'm sorry, go ahead, Amy, did you raise your hand? Oh, you're muted, sorry.
Does Winners still fall into, for the most part, into the USDA map?
It does.
Okay.
Yep. So Winters, Allendale, kind of once you get to the outskirts of Vacaville, you fit within that. Now they can update, they typically update the map once a year. So Dixon has been in and out like every other year. It seems like it's in and then it's out. So that one can be a little bit problematic. But again, you can click that link, you can go around the map and just kind of see what areas might fall within that range.
What's the down payment for a USDA loan?
It is zero.
Zero. Okay. And what about credit score?
Allegedly, their minimum credit score is 620, but again, that automated underwriting system, it it if you have anything under a 660, it is really hard to get approved in that automated underwriting system. So I would on paper it's 620. In reality, it's probably closer to 660. Cool. So I'm going to share my screen because I want to go through some other stuff just because again, I want to just walk through some of the niche products that fall within FHA and conventional. So one of the questions I get a lot is about, hey, what about homes that are fixer-uppers that I need to repair? And so I want to talk about the FHA 203K program, and I've got some slides on that. Let's see. All right, you guys should see that. And I'm gonna present full screen. Cool. All right, so let's talk about FHA 203K. So these, first off, let me premise this by saying this particular product is your primary residence only, and there are two types of 203K loans. The first of which is the limited 203K, and then there's what's known as the full 203K. So the limited 203K allows for you to finance in repairs up to $75,000. So this typically is your new kitchen, new bath, paint, floors, energy efficient upgrades, things like that. We're not talking about, hey, the foundation is messed up, right? We're not talking about the roof they can usually work with in terms of that, but like we're not talking foundation structural issues. And the way that the program works is, let's use an example that you're buying this fixer in, say it's in Fairfield, it's going for 500,000. It needs to basically be gutted, right? It needs new paint, new flooring, just we got to start over. And that house is selling for $400,000. Essentially, what we would do is we would lend the $400,000 for the purchase. And let's say in this example, we need $50,000 worth of money to gut the house and get it back in good shape where they would be able to live in it. We would not only lend the $400,000 for the sale of the house, we would also lend the $50,000 for the repairs. And upon completion of those repairs, the house is worth $500,000, right? So that $500,000 is the actual appraised value that we would use to qualify them for a loan. So in other words, that would be the number that they would need to come in with the down payment of 3.5% for. So this allows them to both buy the house, seller gets made whole, and also get money to repair and remodel the house. The um, the limited 203K is basically we've got a couple of cooks in the kitchen, right? We've got a contractor, we have to bid it out, we have to bid the work out, and we have the appraiser, where the appraiser looks at what the contractor is going to do, comes back and says, okay, right now the house is worth 400 grand, but once he's done, it'll be worth 500 grand. And then we go, okay. And then from there, we close, seller gets their 400,000, $50,000 sits in escrow, and it begins having draws taking from it over time as the contractor kind of continues to start doing some of the work. They reach out and get additional draws until they have completed all of their work. Now, in addition to the limited, they also have the standard or a full 203K. And so with these, this is go ahead, Amy.
Question on the limited, is there a portion of time prior to the work being completed where the payments are like interest only or anything, or is it the full payment from the very beginning on that one?
So it kind of depends. So it depends on whether the house is livable, right? So if they can live in the house, they start making payments immediately. If for whatever reason the work is like, hey, we got to rip out all the floors, they like the bathrooms are not going to have a kitchen, like they can finance in payments up to 9 months on the limited 203K and 12 months on the full 203K, where they can finance those in addition. So let's say again, using our same example, the 400,000 to buy the house, the 50,000 to do the work, and then up to, in the case of a limited, 9 months worth of mortgage payments, all can be lumped into one loan, depending. But again, it depends on the scope of the work and how long that would take, and then whether or not that makes the house unlivable or not. Cool. So the standard or full 203K, this is designed for the big stuff, right? Like we could be down to the studs kind of situation on these, and there's no maximum amount that they will lend as far as the amount that they're borrowing, up to the FHA loan limits within that county. And again, this is where the major stuff comes in, and the real key factor here, and I should say in Solano County, that's 685,000, right? So if we have anything that's going to go above that, this product won't work. But if we're under 685, which is our FHA loan limit, we can work and go through this process. The thing with the FHA full 203K is that it requires a HUD consultant. So that's another cook in the kitchen. So we have the contractor, we have the appraiser, and now we have a HUD consultant. And the HUD consultant is basically making sure that the major work that is happening here is being done and completed up to HUD building standards and building codes. And so they go out at multiple milestones throughout the transaction to be able to check in on it and make sure everything's happening. And again, all these things cost money, right? Your HUD consultant typically is going to charge you $200 every time he or she has to go out there and check on the house, those kinds of things. Appraiser's going to, if they've got to go out multiple times to sign off on work, like all of those things end up costing money. So this is not really designed necessarily for your first time home buyer, 3.5% down. I'm rubbing two nickels together to get my closing costs. I need you to negotiate a closing cost credit. Like this buyer, this isn't really for this buyer because you've got some of these extra costs that get factored in, and it can get a little expensive. The other thing that I think can be somewhat difficult with these is this is not a 30-day close, right? We have so many cooks in the kitchen, especially with a full, that my recommendation is you typically are going to be looking at 45. And if it's a major scenario, you're probably looking at 60-day closes. And so, if you've got a house, an older house in Fairfield that's 450 and it just needs work, but there's no health or safety major issues going on, chances are that listing agent is going to hold out and just try and get a regular offer or a cash buyer or something. But again, if you can find the right situation where the seller is open to a potentially a little bit of a longer close, these can be really, really cool options to provide. One of the things I highly recommend, there's a company that will kind of act as the third party here to keep everybody organized. And I think this is really important because, and no offense to anybody on this call who has a loved one that's a contractor, but they're not real big on attention to detail when it comes to paperwork. And these kinds of things require a lot of paperwork, a lot of just follow up. Hey, I need to make sure that this work is being done on time, etc. And that can be, we can spend a lot of time chasing down a contractor to fill out the right disclosures at the right time, etc. And so I typically will recommend that we have a third-party company that kind of manages the project, if you will, and keeps everybody in line on top of it, tees up everything that needs to get signed for every party. But again, that's a little bit of an additional cost. So that's your 203K for people who want to do a rehab. Go ahead. Sorry.
I was just saying it sounds like a pain in the ass loan.
It is. It is a pain in the ass. I think that was Adriana, but yes, it's a little bit of a pain in the ass, but it solves a problem, right? And so if everybody is kind of in the saddle going, okay, I know this is not going to be the best experience. I say the same thing to everyone about mobile homes. Like that's not going to be the best experience. But if you prep everyone, we can under promise and over deliver on some of these.
I have a question on
Sure.
these types of loans. Are these also called rehab loans?
Yes. So that term is used interchangeably as a rehab or a renovation loan.
Okay, thanks.
You're welcome. Cool. So there's some of your highlights: 3.5% down, 620 minimum FICO score, 55% debt ratio. Oddly enough, I get this question a lot. For you guys, especially, I see why it's important. Everybody gets paid at closing, right? So if the work takes 9 months, you as the agent, you still get your commission at closing. So you don't have to wait for all that work to be done. Your work is done when the actual transaction closes. And the other piece I would mention is a lot of times you got these folks who are like, I'm handy, I can do the work myself. Okay, well, the buyer can act as their own contractor on a limited 203K if they've got some experience as one. Otherwise, you've got to hire a third-party contractor to handle it. And yeah, that's kind of your highlights there. It is allowed for 1 to 4 unit properties. You can do condos, but only on the interior. So you guys probably know this, but on a condo, you don't actually own the building. You own the space inside the building. So anything exterior, walls, roof, etc., that has to be handled through the HOA, not through your 203K. PUDs, manufactured homes, HUD foreclosures, and I don't know why you would need a 203K on a property that's less than 1 year old, but that is an additional little nugget. Now, any questions? Yeah, go ahead, Amy.
Can somebody use a renovation loan on a refinance? Like somebody's got some work that needs done on their house and they don't have the funds to do it. Could they refinance?
100%. And I very much I prefer them because I don't have a bunch of people breathing down my neck on closing times. So I'm a big fan. But yes, so you can definitely share that with your past clients or anybody who wants to know. But yes, you absolutely can do it on a refinance.
Okay.
Okay, so Fannie Mae also offers a similar program. So this isn't an FHA program; it's a conventional program. The cool thing about this one is it is available for second homes and investment properties. So it's not just primary residence like 203K is. And it allows for 3 to 5% down. And again, using our prior example of 400,000, and then the home is worth 500,000 at the end. We essentially, the way that this program works is it allows you to use 75% of that new value to get renovation costs, right? So in this example, we'd be over that. But again, if you've got somebody that can potentially they're looking into renovations and repairs that will greatly increase that value, it's really a good program because as we all know, we don't always get dollar for dollar return on our investment on some of the work that has to get done. But if you are putting in a lot of work that is expanding out the value of that property significantly, it can be a great program. The other piece is it does allow for a lot of the luxury stuff. So if you want a pool, you want an outdoor kitchen, those kinds of things, you can do that through the home style renovation program. Again, 620 is the minimum FICO. As with all conventional loans, 620 is going to be pretty hard to get an approval through the automated underwriting system, but it's there. Amy,
Yes, this one says it
I
can be
love
used for
questions.
investment properties. Do they use, like, if you're gonna do it as an investment property with the intention to rent it, do they take the rent into account on qualifying?
We do. Yeah. So we take 75%. So there's two things that have to happen. Number one, we get what's called a 1007. It's an addendum to the appraisal, which basically says that, hey, upon completion, the house is going to be worth X, and based on similar properties in the area, it will rent for Y. And we use 75% of whatever that number is for qualifying purposes. The purpose of that 75% is the assumption is at some point the property is going to be vacant, right? You're going to be in between tenants. People are going to move in, move out. They're not going to pay 1 month. So they build in that 25% buffer and want to make sure that you can qualify. And you're only getting credit for 75% of fair market value. I will say the caveat to that is that sometimes you may be buying an investment property where there's a tenant already in it and you're inheriting a lease. And essentially, what we would do is we would use that lease, but we would use 75% of that number if there is an active tenant in there. So sometimes it makes more sense to do it that way. Sometimes it's like, man, that lease is super under market. I'm going to fire them out of here with an eviction notice anyway. So I'd rather have the appraiser come up and give me fair market value for qualifying. But yes, we absolutely can use the rental income. Again, for this too, one of the things that's good on is you can do your for folks who are, they're I don't think this is, I don't know if we're allowed to say this anymore. For disability upgrades, accessibility upgrades, you can do those types of things. You can do energy efficient stuff. If you want solar panels, if you want new windows that are double paned, etc. This program allows for that as well. The process is basically the same, right? We're going to get a contractor out there. They're going to give us a bid. The bid is going to go to the appraiser. The appraiser is going to review it and say, okay, at the completion of this particular property, the home will be worth X, and then we'll base our loan off of that number. VA also has a renovation program, and It's very similar to the ones that we've described to this point. Zero down as VA loans tend to be, and you can then roll the renovation costs into the loan. The only caveat with this one is that you are going to be capped at 50,000. So you can't be doing like down to the studs level remodels probably for 50 grand. And it's got to be work that's going to be done fairly quickly. So you only have 4 months to get it done as opposed to 9 to 12 months with your 203K or your home styles. So that's kind of renovation as a whole that fits within these kind of typical loan products that are not super well known. Any questions on anything that we've talked about?
I have a question for you.
Sure.
I know these all have minimum FICO scores, but do any of these programs work, or even FHA conventional VA work for somebody who doesn't have a credit score?
Yes. So typically the renovation loans will not. We call that non-traditional credit, but
Mhm.
for your typical what we will typically try and do is run you through conventional if you don't have a traditional credit score because they offer the most flexible guidelines around someone not having a credit score. So typically what we would do in those scenarios, there's a couple of paths that we can take. A lot of times I just closed one last month where it was a husband and wife. They just got married. The wife has established credit. She owns a home. She has great credit, all these things. Husband, literally zero score. And so in that case, because she made more than 50% of the income, we just used her score and moved on. However, if that's not the case, and you may have one borrower, two borrowers with no score, or the person with no score makes more income than the other person, this is when we would engage with what's called non-traditional credit. And so in those scenarios, what we would do is we would go get what's called a verification of rent, right? We would go back to their landlord, have them fill out, hey, what's their payment history been in the last 24 months? We would use that as a sort of a guide for their payment history. In addition to that, we would also look at things, we could ask for things like cell phone bills, something that's recurring, water bills, electricity, et cetera, that we can establish that this person may not have a credit score, but does have a history of paying the same number over and over and has built up a payment history that way. So you typically are not going to be able to combine that with a renovation loan, but you absolutely can combine that with your FHA and conventional products. And then I'll
Perfect.
also mention that for the opposite end of that spectrum, for folks who don't have a good credit score, right? Like they are below that 620 threshold. I have a product that will allow both FHA and VA down to 500. So, if you've got somebody who's, worried, hey, my credit stinks, what I would say is most of the time, if your credit is down in that range, especially below 580, what we would really need is a large down payment, right? 10% or more. But if you've got someone that, didn't do a good job managing their credit, they inherited some money or something, and they're like, this is my chance, I want to buy a house. There are options for them. So, I would definitely recommend that you have them chat with me because, a lot of what we do is planting seeds for 6 months, 8 months, 12 months down the road for clients. And we want to be able to spend time with those folks to give them guidance. So, I know a lot of times getting them over to your lender partners can be tough. But if you can, we can really provide good guidance. I have an excellent credit repair company. Like, I think most people will find that credit repair companies are garbage and don't do anything well for anyone. The one that I work with is really good. They're really good. They're legit. So if you have someone, they do charge money, obviously. But if you have someone who's willing to spend a couple $100 and do the work of trying to get their credit score up, they work miracles. So if you have one of those situations where they don't necessarily want to talk to me, but they would love to work on their credit, by all means, I'm happy to share that with the group. Cool. Let's see. Going just on the VA piece, we're not talking luxury stuff. It is primary residence. The contractor has to get approved through VA. Yeah, pretty much the same thing. I'm not going to touch on construction loans much just because that's not really truly falling within conventional and FHA. But one of the things that I think is a really good option to pair with these kind of typical programs that we have is what are known as bridge loans. And so I get questions about bridge loans all the time when you have someone who who owns a home now but wants to buy a new one. And the bridge loans are essentially designed to solve one of two problems. Number one, the seller of your buyer, and probably your seller at the same time, they want a down payment. They don't want to sell their other house first, and all of their money for their down payment is trapped inside home equity on their current property. So number one, we can access that equity from the departing residents before selling. The other problem that it's designed to solve is the non-contingent part, right? We all know if you have, Michelle and I have one right now. If we have someone who has to sell contingent, it's really hard to get your offer accepted in that scenario, right? In most cases. And so what a lot of people will do is look for a solution to purchase that new home as non-contingent. And so within this bridge loan family, there are essentially two types of loans. The first of which is a traditional bridge. And the second one, which I am having a ton of success with in some of the really high priced areas like San Francisco, where don't bother coming with a contingent offer, is what's known as a buy before you sell. So I'm going to walk through what those look like. The first of which is a traditional bridge. And so what a traditional bridge does is it basically is a loan that pays off their current mortgage on their departing residence, and then it gives them the equity that they have in their home up to 75% of the value of that home. So let's say in this example, the house is worth $1 million. They owe 500,000 on a current mortgage. What we're going to do is we're going to pay off the 500,000. We're going to give them $250,000 in cash. So now they have a bridge loan for $750,000, but they have $250,000 in their pocket that they can use as a down payment on their next house. So the next house is also going to require a 25% down payment. And the way that the bridge loan works is the bridge loan has no payment. So their departing residents that we paid off their old mortgage and gave them $250,000 has no payment. But it does have a 12-month balloon note, which basically means once you get moved into the new property, it's time to sell this one. You have 12 months to do that. And the interest rate is not cheap. It's 9%, and you pay a 2.25% origination fee up front. Now, the reason for this is this lender knows you're going to sell this house, right? Chances are this loan is only going to exist for 90 days, maybe 120 days. And so I'm not going to make any money on it. So the only way I'm going to make any money on it is number one, I'm going to charge an origination fee. So that's where that 2.25 comes in. And then secondarily, you must also finance the new first mortgage with that same lender. And that same lender is going to charge typically about 0.5% higher than market interest rates. So essentially, the way that the strategy works is you get the money out of the current home, you move into the new one. Yes, the interest rate sucks on both, but you're going to sell your other property. And chances are a lot of those people are going to want to then take the extra equity that they got from the sale, and they're also going to want to put that towards the new home. And so what happens is we have them make 6 payments on the new home mortgage. Once the sixth payment is made, we then refinance that into traditional financing, and then we also put down the extra money that they made from the sale of their departing residence, and it allows them to get into the new home without selling the old one. And one of the big problems with traditional bridge products, well, I should say with bridge products historically, is that most people can't afford 2 mortgage payments at once, right? So the cool thing about this product is that because there are no payments, on the qualifying side on the new house, I don't have a payment that I have to worry about from this other house. So it allows them to be able to qualify with both of those mortgages in existence because that first mortgage does not have a payment. Any questions on that? All right. So let's then talk about buy before you sell, because I think this is actually the kind of cool product. The first thing that there's a couple of different things within buy before you sell that I think are powerful. The first of which is what we call GBC, or the guaranteed backup contract. The way that this works is that we have a third party. This particular lender puts the current home that they live in into a non-contingent contract. Now, why this is important is because if I have a contract on their old home that has no contingencies on it, I don't have to count the mortgage payment. So what this company is doing is they are giving you an offer to buy that house without any contingencies. Now, typically, they're going to lowball that offer, right? They're typically going to give you somewhere between 75 and 78% of the actual market value of that home. And so what would then happen is the client then has 6 months to sell their home on the open market and get rid of that house. And if after 6 months they have not yet sold that property, this third party company is going to buy the house based on the offer that they made them. Now, they don't want to do this. They've done about 600 of these transactions since the product was created, and they've only bought 3 of them. So they are not in the market to buy houses. They don't want to buy them. They want you to sell them at correct market value. It's only when the client is acting unreasonably, and we've all had one of these, that they're overpricing their house and then they won't budge, etc. At 6 months, they come in and they buy the house as agreed. Now, the cool thing for you as the agent is you get paid. So you're going to get paid as normal, but you're going to get paid as normal on that original agreement that you made. If you sell it on the open market, you get paid that way too. So you're basically being squared away regardless. Now, if they do purchase the home, they're then going to put it on the market. Now, again, this has only happened 3 times, but what has happened is they then put it on the market, they get it sold, and 100% of the difference in those dollars goes back to your seller, right? So it's really a risk-free thing. And you also get that listing as well, although most people have not chosen to charge the client twice for 2 commissions. But the cool thing about this is, again, it allows me to eliminate the mortgage payment. So if you've got somebody who has the down payment for the new property, they just don't want to move until they get the new property in, they can set up this GBC. We can eliminate that mortgage, and then they can qualify going forward. On average, that's going to start around $2,500 that they charge to do that. And that's how they make their money, because you're going to sell the house and they're never going to get paid for anything. So they charge that money up front. Any questions on that? Something in the chat here. I see. Thank you, Amanda. We are not allowed to say anything anymore. Okay, so the other piece that this program kind of can kick in is what's known as instant equity. And so this program, for the most part, is very similar to that traditional bridge loan that I gave you. There are no payments due, and it has 9.99% interest, and that, any money that accrues from that 9.99 is due at the sale of the parting residence. And the cool thing about this is how quick it moves. You can get that equity in 14 days. And so most people are doing this in conjunction with that guaranteed backup contract, that GBC we just talked about. They'll do a GBC, so it's under contract. And then at that point, you can get instant equity and access it that way, and you can get it quickly. So that's one way to be able to access some of the equity. Now, one of the other cool things that we can do with this product is turn your buyer into a cash offer. And so the way that this works is that buyer is going to be pre-approved on a traditional loan, right? So let's say they're doing a conventional loan with 5% down. I'm going to pre-approve them with a conventional loan with 5% down. And what this company does is they provide what's known as a cash offer letter. So as you guys know, if you've ever had a cash buyer, the listing agent always raises their hand and goes, "Let me see proof of funds," right? If you got a cash buyer, I want to know they actually have the cash. What this cash offer does is this cash offer letter basically says it is their proof of funds, if you will. And what happens is this matches the LTV from our traditional loan. So again, using our example that we have a client that was going to put 5% down on their own money on a conventional loan. What happens is they bring in the 95% cash. Your client brings in the 5% down. Together, you have 100% of the money needed to pay the seller. The day after closing, we immediately refinance that loan into a traditional conventional financing or FHA or VA or what. Well, I won't say FHA. Well, we could do FHA, but it'd be 5% down minimum. Same thing with VA. So we're going to refinance that as soon as the house sells, and it charges anywhere from 1 and 1.25%. So this is if you've got someone who's like legitimately just needs to look like a cash offer, we can make them look like a cash offer. I always say that like I take your traditional clients, I send them through underwriting in advance to make them look like a cash offer, and we do pretty good with that. This is a legit cash offer if you want your client to do it and they've got the flexibility to be willing to pay that 1% and be willing to go through that. We can then immediately refinance them into their traditional financing. So these products are super, super useful for, we've been having a ton of success in the Bay Area and San Diego, these places where you can't even don't even mention contingent offer. And if you're a 5% down conventional buyer, like good luck, like there's just too many, other options out there that a seller will choose from. So it really can help your clients truly stand out in a really difficult market. Amy.
Can this cash offer program be used for investment properties?
Yes.
Okay. Obviously, probably
So,
with higher down, but
yeah, exactly right. Yeah. So your typical minimum down for an investment property is 15%. So you would need to come in with that bigger difference, but we would then immediately refinance them. Where the value comes in for this company that we work with on these products is we have already pre-approved them, right? So they have to go through the process with me as though they are buying an investment property with 15% down, so that the company that we partner with knows like, okay, these people are golden and I'm not going to get stuck with a loan here that I don't want on the other side. Cool. Last thing I wanted to touch on for you guys is down payment assistance. So down payment assistance is a way for us to get our conventional FHA borrowers in with zero down. So when Adriana, you said earlier about an FHA loan with zero down, this is essentially the way that we would do that, is using a down payment assistance program. And there are a ton of them out there. There are national programs, some cities have them. One of my mortgage advisors who works on my team, she lives in Alameda. Alameda has a 20% down one. It's kind of like Dream for All that she uses all the time. So I don't want to, for the sake of time, I'm only going to focus on two of them. But there are an unlimited amount of these programs that exist. The most common one that we see in our market is known as CalHFA. And the way that it works is the state agency essentially is going to give your client the down payment that they need. So the minimum down payment for conventional is 3%. FHA is 3.5%. CalHFA is going to give you the money for that down payment. So now your client essentially has got the down payment taken care of, and the only thing that they're looking for at this point is help with closing costs. And so CalHFA does have an additional loan that they will give you to help with closing costs, but it doesn't give you very much. So what I usually say is, in most of these examples, we're going to give you the down payment. You as the client are either A, going to have the, 10 to 12 grand for closing costs, or we need to go in and make offers with a $10 to $12,000 credit, right? So that way your borrower comes in with zero. Now, I will tell you, sometimes when you have these clients who are really have next to nothing, you and I need to sit down and be creative, because in some cases they don't have money for an earnest money deposit, right? And so we have to get creative on how we present these options and how we can tackle those things before you make offers. But these programs essentially work as a silent second mortgage. So what that means is there is no payments made on that money that they borrowed for the down payment, but there is a lien against the house that needs to be paid back when they sell or refinance for that 3 and 3.5% that they gave them. The good news is it accrues interest only at 1%. So it's free money for all intents and purposes because it's the interest is lower than inflation. So it's very little, but they do have to pay it back. So a lot of people want to talk about grant money and free money and gifts from the government, et cetera, and those do exist, and we can talk about them. However, the majority of those programs do not give as much assistance as Cal HAFA does, and because of that, most people end up coming back towards the Cal HAFA model because they need as much assistance as they can get their hands on. Any questions on that product?
So they have to, so if they refi or when they sell the property, they have to repay what they borrowed.
That is correct.
Is there an interest
Yes,
on
1%.
1%? Okay.
Yep. So and given that, they're only borrowing 3 to 3.5%, like it's usually a couple $100 above what they had. Like a lot of people don't even remember they took it out, which can be a problem for you. A lot of agents have had this experience where it's like, they told me their mortgage was 300,000 and there was enough equity in there. And then we got the payoff from escrow. And turns out it's 320 because there was a down payment assistance program they took out 15 years ago that they forgot about. So yes, it does pop up from time to time. I will say the big popular one with Cal HFA that gets a lot of publicity is Dream for All, where Cal HFA is giving a 20% down payment. It's a shared appreciation loan, which basically means they're going to give you 20% down payment up front. When you sell the house, you're going to give Cal HAFA 20% of what you sell it for. So everybody wins in those scenarios. That money, that program runs out of money in a matter of weeks from when it gets released. So it gets a lot of headlines. Everybody loves it. Everybody calls me to get pre-approved on it, and then their lottery ticket very rarely gets pulled. So it's a great program, but your traditional Cal HAFA products are the more common that you guys will see.
Is there's is there such thing as someone being overqualified for a Cal HAFA? Because I get a lot of people that have money, but they're always asking about down payment assistance. And so
Yeah,
is there
it's and oddly enough, I don't know if it's been your experience, but it's my experience that those people are the most indignant about not qualifying for down payment assistance. And I'm like, if you just saved 2 paychecks, we would have a down payment. But yes, the income limit for Solano County is $224,000. So if you make over $224,000, you would not qualify for Cal HAFA, though there are other programs out there that do not have income limits. So that's not a complete issue if you have someone that makes a ton but saves nothing. But here locally, it's 224,000 for the Cal HAFA product. I'm going to
for a
put in
family or for a single person?
for all the people that will be on the loan. So if you have one person that's going to be on the loan, they have a limit of 224,000. If
That's
they
pretty high.
Yeah, and if there's 2 people on the loan, 224,000. So our median annual income in Solano County is 91 grand. So even if you doubled that, right, you had 2 people in the house making 91 grand, you'd still be under the limit. And I put the link in the chat to the income limits for all of our local areas. So you're welcome to bookmark that if you ever run into one of those clients. But again, there are other programs out there that do not have an income limit at all. And these are your typical programs, right? So we're depending on their credit score, we're going to be doing either an FHA or a conventional loan. VA loans do exist with Cal HAFA, but it's almost kind of like, why bother? Because you're already getting zero down. So I typically don't go down this route on the VA side, but it does exist out there if someone wants to get help strictly for the closing cost aspect of it.
Is the interest rate typically higher for Cal HAFA?
Yeah, it's a great question. And yes, it is. Let me go pull it up on my other screen here and see what it is today. So if you are using the down payment assistance right now on conventional with Cal HAFA, it's 7.5%. If you are under what they call low income level, which is 92 grand in Solano County, you get a 7.375. So that's about anywhere from 3/8 to a half higher than what I would be offering on a traditional product. So I tell people all the time, because I get first-time home buyers that are super well qualified. They've got money for a down payment, and they're like, what about down payment assistance? I'm like, okay, we could do it, but do you need it? Because otherwise you're going to be paying 0.5% higher than I would offer you in-house, kind of thing. And most of the time they go, oh, never mind. But it is out there, even if you've got money to put down. So even if you put down 20%, you could still get down payment assistance. I wouldn't do it, but it's out there. And then the last product that I'll show you guys is GSFA, Golden State Finance Authority. It's another state agency that comes out and provides assistance. One of the things that I think is somewhat unique about this product is they have some benefits for your first responders, teachers, county workers, anybody who works at the prison, things like that. They get some additional money that's out there for just kind of those community folks. It's not a big amount. I think they get an extra 1% if I remember correctly. So it's not a huge amount, but hey, every little bit helps on that piece. With GSFA, one of the coolest programs, I didn't put it on here just because it didn't really tie in necessarily with conventional and FHAs. They have what's called a Recover California program. And so for anybody who lived in an area that was impacted by fire, going back to 2017, 2020, some of those big fires that we had in Santa Rosa and in our area, if you lived in those areas, they will give you assistance up to 350 grand. You didn't have to lose your home. You just have to live in an impacted area. So it's a pretty cool program. It runs out of money really fast, but when it's out there, it's super, super attractive. So that's something else that we'll keep an eye on for you. And when they get their annual budget, hopefully, as we get into the fiscal year in July, that might be an option for your clients as well. Cool. Any questions on this? I'm happy to talk about anything. I want to honor your guys' time, but if you guys have any general questions, I'm happy to answer them as well. Awesome. Well, again, I appreciate the opportunity to serve. Any questions that come up, we can talk. There's a million other loan products that don't necessarily fall within the FHA conventional VA realm. For investors and bank statements, and we have a no ratio, no income loan at all. So there's other stuff that we can talk through. But yeah, appreciate the opportunity. Thanks, Amy.
Fabulous. Thank you, Jason. I appreciate you coming on today. We will absolutely have you back to talk about the other programs. But I think this gave people a lot of insight to programs they maybe didn't have a lot of knowledge about that tie into our real estate bingo. So I appreciate you.
Yeah. Thanks, guys. Have a great day.
All right. You too.
Thank you, guys. Thanks, Jason.
See ya.